I'm going to look at a company that should be quite familiar to our clients, as it's an actual recommendation. We actually got a comment last week that we don't talk about companies that are in coverage. All right, that we don't always talk about companies that are in coverage. Well, somehow I would say duh, because our clients do pay for that research. But we often do share companies that are in our portfolio after we've recommended them, just to show you, give you a flavor of the companies that we actually, or a taste of the companies that we actually look at and why we look at them. So I'll do that this week. It's actually our star of the week. And it's a company called Vitalhub Corp, symbol VHI on the TSX, $7.78, just under $400 million market cap, doesn't pay a yield, but it's important to know they are directing their cash flow back into the business, making acquisitions and growing organically. What does Vitalhub do? They're headquartered in Toronto. They are a software consolidator focused on the healthcare vertical. While the company's primary products historically include electronic medical records, or EMR software, the patient flow solutions that the company provides are there. There's also case management, case coordination, operational visibility, mobile app solutions that they provide to clients. They provide their technology to health and human service providers, including hospitals, regional health authorities, mental health, long-term care, home health, community and social services. Now, the company has over 1,000 customers within North America and into Europe. Now, what makes it a star? Well, first, obviously, the stock performance. Year to date, the stock is up 93%. The stock performance, this is it since we recommended the stock. This was only recommended 7 months ago to our clients. It's gained 141% over that time. But what's driving the share price? Well, it's a long-term track record, as you can see here, of revenue growth, but it really is the increase in organic growth that we saw and the profitability and free cash flow that has driven the stock price. These are the key elements that we look for in a stock to recommend to our clients. That's what we did this past fall. Cash-rich business, growing free cash flow, and we bought it at a reasonable price in November. This was the original report on the company. Here you can see the highlights. At the time, Vitalhub was producing 10 to 12 million annually in free cash flow. We expected going forward, and they could grow that, which could be recycled back into M&A. We bought it then at under 10 times that free cash flow multiple. Management was targeting scaling the business to 75 to 80 million in the medium term. It had, again, strong organic growth, cash rich it was for acquisitions and still is today, and it traded at under 10 times free cash flow, like I said. So let's look at the latest quarter. Does that growth continue? You can see here Q1 fiscal 2024, we saw 21% growth in revenues, adjusted EBITDA up 38%, and EPS up 300%. The company has a great balance sheet. It's well positioned for M&A activity. You can see here, this is the good mix of organic and acquisition-driven growth that we've seen over the past several quarters. But they do have that strong balance sheet. They are holding 33.3 million in cash pro forma. They just raised some capital, about 70 million, after the recent share issuance and factoring in the acquisition of Premier IT Partnership Limited. In addition to the cash on hand, Vitalhub has access to 27 million in a revolving term facility and an operating line through Scotiabank at $6 million, and it's at about prime +1. The company has noted that the acquisition pipeline improved in 2024 just to start this year, opening the doors for further capital development. They have noted as well the size of the deals in the pipeline is better now. So the growth in the share price make this company our star of the week. And we continue to have a hold, and we like the company over the long term on this stock.
Yeah, I'm glad that you covered Vitalhub, because again, like, we did get that question, or just that comment basically saying, I'm sick and tired of you guys just saying that
Sick and tired, eh?
you
Wow.
monitor these stocks. And what I ended up commenting back and just saying, you have to understand, a lot of the time these your stock our take questions are from people or from viewers. And just because we're reviewing it, like, there's thousands of stocks on the stock market. We're going to be very, very selective. We do come out with, like you just covered in this segment, some of the stocks that, this is why we like them. This is why we recommended them to clients.
Yeah.
But again, it's at the end of the day, our clients pay for our research, and it would be unfair to
Number
them.
one, like, these are the questions we get that we're answering from viewers out there. Clients get our research. They don't have to ask us questions on here. So they get all of our buy, sell, hold reports on a weekly basis, and they get access to our chat sessions where they can talk to us on a weekly basis, and they don't need to do it through a podcast. These are just the questions that we get and answer. And obviously those are paid, but it is our job to refuse far more. There's 35, just in Canada, 3,500 stocks. We may come out with 6 to 10 recommendations in a year. We're going to say no to far more companies than we're going to say yes to. And that's why we are very discerning in our research. But that gives you an example of a company just this fall. Now, that is a tremendous growth story, a tremendous recommendation that we put out there. That doesn't happen every day. But when you're looking, our theme this past year in our Canadian small cap research has been cash rich businesses growing both through M&A or organically. Both, if we can marry the two, is great. And trading at reasonable prices. Well, we've been able to recommend about 5 companies that fit that criteria over the past year. There's other things that we look at in businesses as well, but they fit that criteria. 3 of those companies have doubled. And we just gave an example of one here. Now, this has been an area that we continue to focus on. We just recommended today 2 new companies that have cash-rich balance sheets, net cash positions, growth in the business, trade at reasonable multiples, both under 10 times multiples, growing well above that. And again, that's the product of research we've been doing over the past couple of years into those type of companies. So clients, if you're listening to this, check your inboxes. You got a new special report in there, a couple of recommendations. But you should already know that. But again, this is a profile of a company we're looking for. Vitalhub's an example of that. You can see what that has done in terms of share performance over the past 7 months. Again, we would have expected Vitalhub to maybe take 2 to 3 years to do that. Again, it's lovely. It's great to see it happen in 7 months, but it's the profile of the business that we're looking for. Putting more stocks with that profile in your portfolio is a good thing.
Yeah, and people always say we say monitor. It's because a lot of companies, they are roughly near what they should be.
Yes.
That's just the way the market is you're looking at 50, 60%, even though the market always isn't efficient, and Vitalhub proves it right here, that the market can miss something. A lot of times it is efficient, or at least to a degree where you're not going to see great returns over even a few years like we would look to for Vitalhub normally, or a company with that traits normally. You're not going to find, if you pick 100 companies, maybe one. You're not going to find. So when we're doing 4 your stocks our takes a week, that's 2 a year.
Yeah.
There you go.
And I love how, it is the word we use, monitor, and we actually do monitor. In the case of Vitalhub, I'll go right back to it. We literally have been monitoring that stock for 4 years. We interviewed in person with the management team at least 5 times over that period. I'm sure they were sick of us at some point. When are you going to recommend? But they hadn't hit what we call an inflection point. We sat down with them actually in Vancouver. They were at an event. We had just done up a report on them, but weren't completely convinced, but we were close. And we, came across really looking at the free cash flow of the business at that point. And they had dropped to a range where they were trading a low multiple to free cash flow. We had a bit of what we call a margin of safety with the cash that they were generating, with the free cash flow that they were going to generate. And they traded at, half the multiple of peer companies in Canada, and they were ignored. So that was a time where maybe we never recommend them, but we're looking at them literally for 4 years before we made that recommendation. And it happened to be literally an inflection point in not only the business and the fundamentals, but the stock price. You don't always get it that right, But when you're, again, that profile of the business like that, and you can have that inflection point and produce those type of returns that really power a portfolio for our clients.